First and foremost, we are going to kick off with my favorite precious metal, gold. Let's take a look at what managed money and open interest are telling us about gold right now, Nick.
Yeah, absolutely. So the first thing is that for the first time in at least a month, we've actually seen a slight increase in the managed money positioning. Managed money positioning went up by 1.25%, 184,000 ounces, more or less, takes the managed money position up to 14.8 million ounces, just shy of 15 million ounces. What we also saw on the managed money shorts was they stepped up a little bit, sold about 851,000 ounces. That's actually a reasonably decent increase percentage-wise because the shorts are a relatively small position. They now are short, of course, as of Tuesday the 5th, they're short about 4.7 million ounces, and that's a 22% increase. So you kind of see those guys at that time taking a more bearish viewpoint on gold. Obviously, since then, the price has only rallied, so they're probably, doubtless on the defensive. So looking at ETFs, and this is up to the 12th of April, the ETF position grew to just over 106 million, about 106.25 million ounces. If you want to compare that to the start of the month, about 106 million, and the beginning of March, 101 million. So it's a steady increase, especially if you compare it to the beginning of last month. So having looked at the positioning, there's a few different things going on in gold at the moment. You've had a rising US dollar, rising real yields, weakening crude, and no end to the expectations of rapid tightening from the Fed. They're all part of the bear case for gold. The bullish case for gold really arising from broad-based inflationary pressures, the belief that the Fed and other central banks won't be able to suppress that inflation, get on top of it. And also there's no doubt about it, increasing geopolitical tension arising from the expected growing clash in the Donbass region over the next 2 weeks or so. And the significance of that, from my understanding at any rate, is that Ukraine can't allow the Russian forces to take Mariupol and form a land corridor that links Donetsk with the Crimean Peninsula, as that would effectively enable Russian control over the whole of the Ukrainian coast of the Sea of Azov, and also give them access to a very important deep water terminal. So that's a struggle that is almost certainly it has to happen, and it's obviously going to be accompanied with a rising tension. I think that's part of the gold story at the moment as well. So looking at the high inflation bit that, and the concerns that central banks aren't responding rapidly enough. It's interesting listening to some of the language that's coming out. The concerns really that both of these things help gold. Either that central banks don't respond rapidly enough, or that they do respond really rapidly and they trigger a sharp recession. Both of those cases could be said to be a positive case for higher gold prices. James Bullard of the Fed, he just added that he believes it's a fantasy to think that modest rate rises will tame inflation. I think that's probably a very fair take. Otmar Issing, who was the first chief economist of the European Central Bank, he's reported as rebuking the ECB for persisting with quantitative easing long after the case for normalization had been made, in his view. He also described the ECB, the European Central Bank, as living in a fantasy. And I can remember the days when central bank analysts would interpret pronouncements as if, running their fingertips over sort of time-worn hieroglyphs. And it's no longer the case. You're either living in Fantasy Island or you're not. The language has changed.
The language certainly has changed, but one thing I will not step over before we move on to silver is the cloud. Now, as you know, I am a cloud convert and I believe in the power of the Ichimoku cloud. Let's talk price targets. What is happening within the cloud at the moment for gold?
Well, look, we often look at the weekly cloud, but the most relevant time frame, I think, in terms of support and resistance and so on, as we speak, is the daily cloud. Now, daily cloud support, looking at the support level, it's about 1952 thereabouts in US dollar terms. We've obviously little bit further away from that. We're in the 1970s now. Looking at the resistance side, there's a couple of resistance levels that have been key this week. One thing is that the recent rally is capped at the 50% retracement of the big March drop, March highs to lows. The low, if you recall, is $18.90 US. Now, that 50% retracement also happens to coincide, or it did yesterday, with the daily standard line, and both of them interacting to form a resistance as of now, coming in about 1980. That's certainly still a good resistance level, and if we do get through that level, I'm pretty sure that it looks like from today's price action, there was some reasonably good distribution around that level, and people happy to let go of any longs they had, and maybe even take a few shorts. If we do get through that level, then I think we'd look at 2001 pretty quickly, and that's the next Fibonacci retracement level. I think I'm not going to guess, actually. I'm just going to turn up the piece of paper and have a look. Yeah, it's too, because, sometimes the memory. So 2001, that's 61.8% Fib level. So I think if we did get through 1980, if you're looking at stuff over the next week, I think gold would ping to that level quite quickly. But at the moment, support 1950, 1953, really.
Look, it's still a good level of support for gold.